You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
The trading day doesn't start when the opening bell rings. Pros understand that risk never sleeps, and market-moving events happen around the clock. How can you arm yourself with the information you need to understand what's going on across the pond and how it can impact your portfolio? Welcome to the European Market Brief, your go-to source for information on the fast-moving European derivatives markets. Each episode brings you expert insights into the latest market trends, discussions of cutting-edge trading strategies, breakdowns of exciting new products, and analysis of thought-provoking trading activity. The European Market Brief, brought to you by Eurex, is your trusted source for the latest insights on European trading and market trends. As the home of Euro stocks, VSTOXX, DAX, and European rates derivatives like the Bund, Bobble, and Schatz, Eurex stands as the leading European derivatives exchange. Learn more about trading Eurex futures and options at www.eurex.com. So join us as we shine a spotlight across the pond and explore the cross-border volatility, regulation, and innovation that makes the marketplace so fascinating. It's time to get the European Market Brief.
All right, everybody. That music means it is time once again for the European Market Brief. To me, this is one of the new additions to the network. We're already on episode 8, wild. And we've already launched an additional show since this show launched. So a lot of fun things going on the network. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the aforementioned network. A lot of fun coming at you these days. So make sure you're subscribed to the full network, wherever you're getting this, on whatever platform you choose to consume it on. And of course, if you think you're ready, you want to go above and beyond, you want to join us for the live streams for this show, every other show we do on the network, pro Q&As, options oddities, giveaways, all sorts of exclusives. The optionsinsider.com/pro is the place to go to learn more as we learn who's joining us for episode 8 of the European Market Brief. First, to the hallowed halls of Indiana University we go, where we are joined once again by our good buddy Holden Court over there at the Kelley School of Business, none other than Mr. Russell Rhoads, a.k.a. the once future and present Dr. VSTOXX. Mr. Dr. VSTOXX, how are things, sir?
I love how we changed my name for the European crowd versus the U.S. crowd. That's nice. I finally got a name for you. You've been nicknaming people for a million years. Mm-hmm. And I'm going to give you one that Dan Sheridan gave me back in the day. He used to call me the hardest working person in the option industry. Oh. I am not the hardest working person in the option industry anymore. Mark Longo is.
Well, I appreciate that, sir. Your buddy, the Rock Lobster, calls me the benevolent dictator of the network and indeed the options markets. I'll take a little bit of column A, a little bit of... We are putting out a lot of content these days, so my voice is getting a workout. So it should be a fun one. And alongside our good buddy, Dr. Vic/VSTOXX, we have two newcomers to the program and indeed to the network. First off, joining us from SimCorp, we have Christoph Schon, the lead principal over there. Christoph, welcome to the European Market Brief, sir.
Thank you, Mark. It's a pleasure to be on this show. Been following you and really honored to be on this. So I'm responsible for SimCorp's investment decision research in Europe, based in London. And for those who are not familiar with the name SimCorp, we are a fintech company within Deutsche Börse Group. So we're a sister company of Eurex, and we specialize in investment management software, spanning the entire investment process from idea generation, portfolio construction, risk and performance analysis to fund accounting and client reporting. My team sits closer to the front of the system. So we use the Axioma risk models and portfolio analytics tools to analyze financial markets and help our customers make better investment decisions, hence the name Investment Decision Research. I personally joined Axioma more than 9 years ago. So that was before we were acquired by Deutsche Börse in 2019. But I started my career in 2000 as a research analyst at what was then Dresdner Kleinwort Benson in Frankfurt, until I got an offer from a bank called Lehman Brothers, might have heard of them, in London, to join their index and point team in 2006. So I was there until September 2008. After that, I spent about a year at Barclays Capital before moving to UBS Investment Bank in late 2009.
All right, and let's keep on rolling with yet another newcomer joining us on the program here. We have Zubin Ramdarshan. He is the global co-head of derivatives, products, and markets. Say all that 5 times fast. Over there at Deutsche Börse. Zubin, welcome to the European Market Brief, sir.
Mark, thank you very much. European brief, but very much I perceive US energy. I'm liking it already. Little bit of background. So I've been at Eurex, preeminent derivative exchange. We try to compete with the big boys in Chicago. I think we do very well. Our footprint is very much European, but we see ourselves absolutely as the global gateway for investors based in this region. I've been here now coming up to 9 years, but spent the previous 18 years as a customer of the exchange. So I was a derivative trader before, had the pleasure of working at a number of European as well as US investment banks, trading volatility, trading convertible bonds, trading dividends, trading repo. So really, I guess, equity derivatives very much in my DNA. Very happy and looking forward to talk about them today with you.
All right, then let's get the conversation going with a little bit of the old continental conversations.
It's time to catch up with the thought leaders who are shaping the European derivatives markets. It's time to have Continental Conversations.
Mr. Rhoads, you have corrupted our live listeners. They are agreeing with you now that I am the hardest working man in options. So I appreciate that love, even though some of them prefer the title of the benevolent dictator. I'll take a column A, column B. One's a little nicer than the other, but at least I'm a benevolent dictator, if that's such a thing. All right, welcome to the Continental Conversations, the portion of the show where we dive a little deeper into a topic or a market or a product area, sometimes a combination of all three, across the pond, and maybe compare and contrast it to what you might be used to here in the U.S. And we've delved into a lot of different areas in the European derivatives landscape over the last, now coming up on 8 episodes here today. We've talked about vol, we've talked about the fixed income, we've talked about a variety of different things, some of the products you can trade therein. We're gonna dial it back a little bit today, take more of a 10,000 foot perspective on the overall European market and the landscape therein. Everyone's familiar with the big names here in the U.S. and the big hot market sectors and what everyone is obsessed with here in the U.S. markets. But how does that translate overseas? What are the hot markets? What are the hot names? What are the hot sectors? What are some of the fun flows looking for over there in Europe right now? So let's dive right on into it. Maybe Christoph, we'll start with you. Everyone here in the U.S. is used to and probably sick of the conversations we've been having for the last probably 4+ years now. They've heard about the Mag 7. They've heard about the concentration in a handful of names that is driving the U.S. marketplace. And again, they're probably sick of that by now. But let's flip the script. Let's go across the pond a little bit. As I'm looking at the European market, what are some of the big names over there that those folks should be aware of? And along those same lines, we've been hearing this for a while, concentration risk here in the U.S. doesn't seem to be derailing the bull, at least not yet. We continue to rally almost every session out there. But are we hearing the same lingering and echoing concerns across the pond in Europe, Christoph?
Certainly when it comes to concentration, Europe is a lot less concentrated than the US for sure. And just to put things into perspective a little bit, you mentioned the Magnificent Seven. So in terms of market capitalization, they account for about a third of the S&P 500. Even when it comes to risk, they're probably responsible for 40% of the volatility of the market, and also about a third of the year-to-date return of the index. So certainly it's very, very concentrated. It is very, very different in Europe. So if we look at the STOXX Europe 600, which is probably one of the best-known benchmarks for the European market as a whole, there the top 10 names represent about 17% of its market capitalization. So that's half of what the Magnificent Seven account for. And also they are spread across many more sectors. So the Magnificent Seven, they're mostly in information technology, communication services, and consumer discretionary, and all of which are very highly cyclical sectors. In Europe, the spread is across much more industries. Yes, we have technology, but we also have healthcare, we have energy, we have financials, and we have the consumer sectors. And also, they were only about responsible for 1 percentage point of the 9% return we've had so far for the STOXX USA 900. So it's much, much less concentrated and more spread out than it is here. The biggest names, you may have heard the term granolas, that the Goldman Sachs coined that about a year ago, I think. So they used to be the biggest companies. They're not anymore because we've also had quite a bit of movement there. So some are still in favor, some have fallen out of favor. But they are healthcare names like GlaxoSmithKline, Roche, Novartis, AstraZeneca, Sanofi. Some of them are in the luxury industry, Louis Vuitton, Moet Hennessy, and also what else? L'Oreal. Then we have the chip manufacturers, ASML, SAP, another tech company there, but also like lots of financial companies, Allianz, HSBC, then Shell, of course. So it's a much, much wider range in terms of the sectors and countries and names that we have here compared to the Magnificent Seven.
All right. So a little bit more diverse, a little bit less, shall we say, concentrated in just a handful of names out there, which is refreshing, I know, for a lot of you out there who are listening to this, and you're maybe a little bit tired of talking about the same 7 to 10 names that seem to dominate the tape here in the U.S. That said, if you're listening to our newest show, the Hot Options Report, you'll see a lot of new names breaking in the top 10 in the options market just in the last couple of weeks. So maybe there is some hope for the future, but I digress. Let's keep rolling over to Zubin. Now, Christoph just kind of broke down some of the structure. He alluded to the sectors, which is a hot thing for both U.S. and European investors. I know Eurex has a variety of sector offerings over there. If folks are looking to maybe trade some European sectors, Zubin, what can they sink their teeth and their trading accounts into?
Well, there's one that they trade a lot of already. So the preeminent sector, so you've got XLF in the US, we have the bank sector. So in the US, your spider sectors, XLY, XLU, XLK, XLI, etc., they all follow the GICS construction. We follow the ICB, which is a FTSE Russell, so also highly credible, highly reputable classification system. Of those sectors, I think now we have roughly, and this is where the European landscape probably needs a bit of consolidation of products, we have the Eurozone sectors. So the bank sector is a Eurozone banks index. It's also got, I think within that, you've got the names like Commerzbank, UniCredit, Deutsche Bank, which on their own are also highly traded equity options markets. The bank sector right now is an interesting one. So it's probably at a multi-year high. That said, it's still unbelievably below where it launched. So it's one of the few indices which is still down where it was due to a combination of crisis like Euro crisis. They've never quite recovered in the way that global banks have elsewhere, but it's still an index that attracts an immense flow of both futures and options. So the VSTOXX Banks Index is by far our most successful sector product. Outside of that, actually, interestingly, the most active sectors are the broader STOXX Europe one. So the difference between Euro Stocks and STOXX Europe, I know, forgive me, sounds near identical, is the Euro Stocks are the Eurozone, so euro-denominated constituents only. The STOXX Europe are much broader. So what Christoph was talking about, you add then UK, you add Swiss, and you add the whole Nordic region as well. So the STOXX Europe sectors are much more broad-based. We definitely see a range of trading. I think if I look at the STOXX Europe sectors, automobiles and parts is highly active, food and beverage, healthcare, basic resources, so mining. We have an ecosystem similar to the US in terms of being able to place I would say the sort of omnipresence of the bank sector. It seems to have captured, I guess, the attention of US investors. That one is by far away the leading product in terms of volumes, liquidity, both futures and options. We also have, because it's such a widely traded product in the ecosystem. Eurex, we're kind of the leader when it comes to what I'd call hidden assets. We also have a dividend future on that. We also have a total return future on that banks index as well. So there's a lot of plays not only on volatility, on direction, but also on dividends and the repo essentially of the banks sector.
All right, and Mr. Rhoads, Zubin mentioned the Russell 2000 and, of course, small caps. Small caps, very hot here in the U.S., especially from a volume perspective over the last week and change, just putting up absurd numbers out there. So it's been a wild time on the small caps front. I know when you're out there teaching the young minds of the future, you do a lot of breaking down of the European market landscape versus the U.S. In particular, I think you've noticed a few interesting things in that stratification between the large caps and the small caps. How does that differ across the pond versus here, sir?
Actually, it's more of a similarity, and it's something that I think it goes beyond the Magnificent Seven. But one of those factors that we talk about in the academic space is that small cap outperforms large cap. That we're right now, if you look at, there are several indexes, but if you're taking a look at the small 200, which is, I believe, the smallest 200 of the VSTOXX 600, it is underperforming the VSTOXX 50 for the fifth year in a row. Long term, the performance flipped a few years ago between large cap and small cap. Long term, large cap has outperformed small cap, and that is, you can see that when you compare U.S. indices and large cap U.S. indices and small cap U.S. indices. But even when you take a look at the VSTOXX 600, which is not necessarily small cap index, but it's got some smaller components in there versus the VSTOXX 50. The 600 had outperformed the 50. If you start at the last day of 1989, had outperformed over the long term through about 2023, and then they flipped. And I've seen that in a lot of global indices where the long-term outperformance of small caps, it's not holding up, and we're not just talking about a year or two. And you've just got to question: is this a structural difference where the large companies are able to dominate whatever businesses that they're in? Google over here in the States, whenever somebody comes up with a really innovative idea, they buy them out. So, and they're buying them out before that small cap stock turns into a large cap stock. And I would assume that maybe we're seeing a bit of that in Europe as well. But that we have all those fun rules of thumb in Wall Street. And one of the fun rules of thumb is what something works until it doesn't work anymore. And I just wonder if, there's ever going to be a decent period of outperformance for small caps, at least, in the current environment that we have right now.
Interesting. Speaking of performance, Christoph, we mentioned some of the sectors earlier, obviously, but Russell was just talking about the performance of small caps here in the U.S. versus across the pond. Maybe some surprises lurking there. One of the things we've all had beaten into our head over the past few years is just the ridiculous outperformance of the Mag 7 and in general the big U.S. markets. They've been on a bull run for seemingly ever, powered by the magical two hopes of AI and, of course, the forever hope of rate cuts, which have yet to materialize. But nonetheless, the bull has the bit in its teeth. But coming into this year, things may be changing a little bit. The European benchmarks perhaps stealing a march on us over here in the U.S. Give our listeners a little overview of some recent European index performance. And do you think maybe Europe poised to continue this run for a little bit, Christoph?
First of all, I think I want to add one of the performance drivers of the U.S. market, and that is the unshakable confidence and optimism of the American consumer, which I guess is also behind that spectacular run. Here in Europe, it's a bit different. There was a lot of talk about recessions, sometimes very long recessions. So here we had a lot more negativity about the economy, which was also reflected in valuations in the equity market. So we were starting here from a much lower base, which I guess explains why Europe has outperformed the US very recently, because now there's a lot more optimism. And also, of course, with those infrastructure and defense spending announcements that we've just had, so 800 billion euros across Europe, the ReArm project, and also Germany alone, also 500 billion euros, and they're not included in those 800. I think probably part is, but that's also defense, infrastructure, and the transition to net zero. So these are all specific drivers that we have here in Europe, which have benefited the industrial and construction sectors quite a lot. Zubin also mentioned the banking sector, which has been extremely popular, and it's actually one of the best performing sectors. So I think the banks index is up over 60% year to date, and that probably has to do with the volatility in the market. So the trading activity that we had on the back of that, and I think many of the banks had a lot of commission income from that, and also quite a few of them have announced share buybacks on the back of that. Some banks have doubled their share price since the start of the year. So it's no wonder that we're seeing a lot there. But I guess the one that really stands out is probably the industrial sector, and within that aerospace and defense. And I don't know if you want to go into it now or if we kind of keep that for a little bit later for a deep dive.
We'll come back to defense in a little bit. We'll leave that as a bit of a dangling tease, because obviously that's top of mind for a lot of people over there these days. The defense sector in Europe, after being, shall we say, dormant for the better part of the last half a century, suddenly roaring to life over the last few years. I wonder why that is. And some recent developments may be driving some of that. So stay tuned for that in a little bit. But I want to hit on something you were just talking about for a second, the banking sector over there in Europe. And in particular, maybe if folks are intrigued, Mr. Rhoads, and maybe they heard what Christoph was just laying down, and perhaps they want to trade a little bit of those banks. What info do you have for them, sir?
So they're just different, and there's a reason that we do these podcasts, because there are just different characteristics when you look at different marketplaces. And in the U.S., when you want to, if you wanted to get exposure to the banking sector, you'd probably take a look at the bank ETF. Well, in Europe, they do have sector futures, and the bank sector future over there trades tremendously well. It's traded about 55,000 contracts today. The comparable contract at CME Group is traded about 10. And the bank outperformance and underperformance, and just because I've been on here for a while, I'm a big fan of spread type trading. There are lots of great opportunities to trade the EuroStoxx banks futures versus the EuroStoxx 50 futures. So if you think there's going to be outperformance or underperformance within that sector, but also it's a very, it's a very important sector to the European continent, and it's very easy for U.S. investors to get access to it through the bank's futures. Some sector futures don't really have the liquidity, but whenever I hear people talk about European banks, it automatically clicks in my mind that there might be something to do between the EuroStoxx 50, maybe even the EuroStoxx 600, and the bank's futures.
All right, let's keep this party rolling. Zubin, we were talking about a lot of drivers that come out of the U.S., and for a lot of our listeners, that is kind of what they key off of. But of course, they hear the developments in the after hours, could be in Europe, could be in Asia. From your perspective, how linked are the European markets to what we're seeing here in the U.S.? We see a big, predominantly U.S.-centric headline driving the markets up, down, could be the Fed, could be whatever, could be inflation like we saw last week, driving a lot of action in the markets. How responsive are the European markets to these, or are they kind of moving to the beat of their own drum? And then also along those lines, as we're looking at the European market, we say that term, we throw it out there all the time, the European market, but it's actually an aggregation of a variety of smaller markets. We have Germany, we have the UK, we have, Italy, and all these different regions of Europe, and there's all different types of trades and different fund flows going out there in all these different regions all the time. So along those lines, what kind of intriguing fund flows are you seeing between those regions? Break it down for us, Zubin.
I like the question. I'll start with the last part, Mark. So you're quite right. If you look at the European benchmark, the one that's the oldest one, let's say since the late 90s, is of course the EuroStoxx 50. I think reasonable question to ask, is there now a dual benchmark structure as we have the Stocks Europe 600 catching up rapidly, although it comes from a much lower base in terms of volume and open interest. So if you look at staying on the EuroStoxx 50, look, breakdown, heavy weight, effectively Spain, Italy, Netherlands, thereafter. There are times when that Eurozone has very different dynamics. I think I cast my mind back barely just over a year ago. You had suddenly French President Macron, who I know is featuring prominently in US headlines at the moment for very different reasons, but he called a snap French election, right? And there suddenly you have very different dynamics across the Eurozone because French equities took a bit of a hit compared to, say, German equities. So there are, I would say, certainly periods where country macroeconomic geopolitics drive investment flows. But one thing that seems to have changed this year is the sort of correlation of all the European equities in a sort of positive direction. So this, let's say, driving European sentiment, it definitely seemed to be a feature this year. I think the question on everyone's mind is, will this continue? I think, the whole sell US, buy Europe, I think, is it a blip? I think that's a reasonable opinion. Is it maybe an inflection point where we see the themes which drive Europe now, like defense spending, where there's been on the back of the Russian aggression in Ukraine, and what seems like, and I use the word seems because I know how the European political landscape can develop. It seems like there's a harmony amongst leaders to really concretely spend a significant proportion of GDP on defense. If you look at the details, though, within that European community, the countries that are actually already spending the most are Latvia, Lithuania, and Estonia. And you only have to pull up a map of Europe to understand why that is. They all share borders with Russia or Belarus, right? So they feel the pressure locally. And whereas I think there was a meeting of the leaders in The Hague not too long ago. I think even your own President Trump attended that meeting. And a picture paints 1,000 words. If you looked at that picture where they had the group, what they called the family photo, the group family photo at the end, you had President Trump center, and then you had the Spanish president. I mean, he was almost falling off the stage. He barely wanted to be in that photo. Why? I mean, he looks at his country. He's like, you know what? I'm so far away from Russia. I'm not really feeling the pressure to commit. I mean, in the end, he signed the document on the behalf of his Spanish voters, but I felt very reluctantly. So this sort of theme, which has really captured, I think, a lot of European momentum, i.e. defense spending, and driven, I think of like Rheinmetall, some of the big French aerospace companies, to propel their equity performance. I think, in coming years, there'll be some headwinds to face. European politicians don't always sing from the same hymn sheet.
I like that visual of the Spanish president falling off the stage on the photo. But Christoph, anything you want to add along those lines of the various fund flows we're seeing over there in Europe right now? And then we started the show joking about the Mag 7 here in the U.S., but I know for a lot of our listeners, that is still the lens through which they view the market. So if they're looking across the pond, they're probably thinking tech first and foremost. So what would be some of the analogs they could look to over there in Europe? It's an overused, almost cliche at this point, but if there is a Mag 7 of Europe from a tech perspective, lay it down for our listeners, Christoph.
Yeah, I think the reason why everybody associates the US with tech is because those big tech names, they're constantly in our faces, like literally right now. So we've got Zoom, we've got Microsoft, we have Google, we use Google, all the social media apps. So they're constantly in front of us, which is not surprising. If you think about the European tech sector, I guess maybe the names that are kind of familiar in everyday life might be the likes of Spotify, so the streaming service, and also maybe Logitech. So Logitech supplies keyboards and mouses. So I think about half of them or so globally come from Logitech. So they're the ones that we might be familiar with. But most of the tech companies in Europe are further away from the consumer. So it's mostly about deep tech. So think about maybe SAP. So that's kind of the enterprise operations software as one of the biggest names. And one you may not have heard of is ASML. So you might know that about 90% or so of our chips are currently manufactured in Taiwan, and also the chip market is dominated by big American names. But ASML is actually probably the only company in the world that builds the machines that we need to produce those chips. So that one is of incredible strategic importance. But as I said, for us, technology is maybe a little bit deeper and further away from the consumer than it is in the United States.
All right, let's keep rolling. Right now, Zubin, we are in the middle of earnings season. In fact, this week, as we're recording, listeners, is big box retail. So we're getting our glimpse into the performance of a variety of names. Of course, we had a lot of big tech names popping off in the first few weeks. And the takeaway from the last few earnings seasons, I should say, really, it's just been buy all the earnings vol you can, because it's been dramatic outperformance. We've been tracking this data and crunching it for a while now, well over half a decade, and these are by far the most explosive couple of cycles we've ever seen. So wild times out there on the earnings front. But let's go across the pond, Zubin, to the earnings scene and indeed the earnings season over there in Europe. Let's start with the 10,000 foot question. How big of a driver of volume and flows and activity is earnings season over there in Europe, sir?
It's certainly a driver, Mark. I don't think we have quite the level of attention and I would say, speculation around release of earnings. I mean, for investors here in Europe, though, those US earnings, they're all bellwether companies. So, if you have a Meta, an Apple, and an Nvidia, the companies that are in that 4 trillion or close to that 4 trillion club, missing or hugely outperforming, it just simply has a follow-through effect on Europe. Where we sometimes see, even in our markets, I would say, positioning for these kind of big earnings is actually in our daily options. So we also have VSTOXX 50 daily options. We were a little bit behind the S&P launch of those daily options, but they are used around event trading. And event trading, I would have said originally political voting, big tax decisions, big kind of government policy releases, certainly central bank interest rate decisions. But now that event trading encompasses also, big earnings release for the, the Mag 7 or the big bellwether sentiment setting companies in the US. So, I mean, if we look at Europe, the question on earnings is always around, we talked about, Christoph mentioned the big tech sector. The other, I would say, big draws in terms of, what retail or what we like to call pro-tails, so professional retail customers look at, is not only those tech names, but also I think we have a very deep bench of luxury goods companies. LVMH. If you think of LVMH, you immediately consider Louis Vuitton, Christian Dior, Givenchy, Fendi. I mean, these are kind of brands where even your American consumers are very familiar with those brands. You have Kering, Gucci, Yves Saint Laurent, Balenciaga, Bottega Veneta. So we in Europe, the luxury sector, the earnings for LVMH are watched heavily. Kering are watched heavily. The other sort of earnings, I think, focus and sector is biotech and pharma, right? So we talked about pure tech. I definitely would like to talk about biotech. I mean, one of the biggest company in Europe. I still have to check what its market cap's done after the share price took a massive hit recently, but Novo Nordisk. So Novo Nordisk, the maker of Ozempic, I think out in the US you have the other brand Mounjaro. So essentially the weight loss drug trend. They recently just announced they're cutting I think in the US, the cash price of Ozempic to under $500 per month if you pay up front. That is that's a European stock that has options that are traded at Eurex. There was a huge move recently. I think it was the biggest move that stock had for a number of years. I think circa 30% down. So we have those, I would say, dynamics in the European market where there are certain companies that, if you're looking at testing of new drugs, how they're being performing in trials, they're watched heavily, and you get a lot of options positioning around those kind of releases from biotech and pharmaceutical companies.
A lot to unpack there. Russell, all this talk of the sectors and the flows and the earnings data and the differences between the U.S. and Europe makes me wonder. We've been crunching the earnings vol data for a long time. I think we're kind of the mecca, certainly for free earnings vol data and the markets here in the U.S. Maybe Mr. Rhoads, maybe we need to expand our purview. What do you think? Maybe add a European earnings vol report to the mix. What do you think about that, sir?
Absolutely, and it's interesting what was pointed out about zero DTE options. I've been paying attention to them ad nauseum. I was involved with Eurex when they launched them and monitored them and wrote up how the VSTOXX 50 short dated options were behaving relative to their U.S. counterparts. One of the things that I had picked up on, and I'm a big fan of using the 1 day at the money straddle as kind of a market predictor of volatility for over the short term. And I had noticed that when we have a big European component, and I noticed I really picked up on it when ASML reported back in July. The 1 day at the money straddle on the VSTOXX 50 was a little bit elevated pricing wise to where it is normally. I feel like it was around $40, and normally it should have been about $32 or $33 that 1 day. The ASML, their at the money straddle was priced at 39, and it went out at around 80. They had a big outlier move the last time around, so the VSTOXX they predicted it quite well. One of the things that, and I'm going to deviate for just a second because I know there's a question on this about the short-dated index options in Europe versus the U.S. I have noticed, because there's a lot of systematic selling of especially SPX, that because there's this systematic selling of SPX, it's very difficult to make money taking advantage of that risk premium that we like to talk about. That's not true over in Europe. There's not as much systematic selling within that market. And I feel like those options behave more like you would expect than their U.S. counterparts. And I don't know if that's, again, because there aren't ETFs that are out there selling them every day, or what the reason is behind them. But if you really want to spend a weekend going down a rabbit hole, take a look at consistently being long U.S. volatility with short-dated options and short European volatility with short-dated options. I do think that there's a lot that could be done there. I know I went way off path there. Sorry, guys.
I like it, sir. Can't help myself. If you like that, listener, stay tuned. Russell is correct. We do have a listener question along those same lines coming up in the red phone. But before we get there, we teased it earlier. I see you folks asking about it in the live stream as well. Yeah, we're going to get there now. Let's talk about defense. And as I was only half joking before, but if you came on this network, let's say prior to the Ukraine invasion, and asked about the European defense sector, it'd be kind of like asking about rates 5 years ago. Nobody cared. Nothing was going on the European defense side. Fast forward, let's just say an aggressive Russia on the borders of a lot of these European nations has suddenly reawakened the conversation of defense. We have a lot of nations that have spent the better part of the last half century not really spending on defense, suddenly joining NATO and suddenly arming up. So we're seeing a market trend towards the defense sector over there in Europe. It's definitely one of, if not the hottest sectors. Of course, we have the meetings going on in DC as we're recording this, listeners. So a lot of evolution and a lot of breaking news on this sector right now. But Christoph, sir, we'll start with you. Obviously, defense very much top of mind in Europe right now. What are you seeing, and what are some of the interesting developments we're seeing in the European defense sector right now?
Yeah, you asked earlier that question, like whether we're looking at what happens in the US here from Europe and how important that is. And of course, it's incredibly important. But there are these odd moments where Europe briefly decouples from the US stock market. And Zubin mentioned the presidential election in France earlier, but one recently was at the beginning of March. So at the end of February, we had the first tariff announcements and share prices dropped everywhere in the world. But then Germany came out and said, oh, we're going to suspend the debt brake for defense and infrastructure spending. And that gave a boost to European markets. And that was mostly due, of course, to the defense sector. And also, this is probably the biggest driver behind the DAX's return. DAX is the German benchmark index, which is up 20% this year. So more than double of the European and the US markets right now. And this is to a large part due to the defense sector. I think the name that stands out is Rheinmetall. Rheinmetall is up 160%. So maybe the name Rheinmetall doesn't mean anything to most of our listeners, but they're actually the ones who build the guns and kind of the steering systems, fire control systems for the Leopard 2 battle tank. So they had quite a spectacular performance. And Rheinmetall alone accounts for about 5% or so of the STOXX Europe 600's year-to-date return. Also, in the UK, we have the big names BAE Systems, we have Rolls-Royce. Again, it's not the car maker. The car brand is actually owned by BMW, but they make the jet turbines. So again, much of the good performance of the FTSE 100, up 11% this year, is due to these names. But there are a lot more. So there are Leonardo, Thales. One name, again, that is maybe not on everybody's radar is a company called Hensoldt. So they also built the radar and optical electronics for the Leopard tanks and also for the Eurofighters. And it's a huge potential there. And they've had spectacular performances already. But we're looking at, again, 800 billion from the European Union over the next 10 years, 500 billion from the German government. So there is still a lot of potential and a long way to go in the defense sector in Europe.
All right. Hard to believe, but we already are starting to come up against it. Time flies when we're talking all things European markets. I do want to get to some listener questions, but before we get there, let's go around the horn one final time for everyone. Have them give us their final thoughts, maybe interesting takeaways as they're looking 10,000 foot at the U.S. markets and the U.S. corporate structure versus what we're seeing over there in Europe. Maybe Zubin, sir, we will start with you, sir. Any final thoughts or takeaways you want to leave with our listeners on this subject?
Yeah, I'm going to be I'm used to being a lone voice. I'm mega bearish at the moment of US markets. Why? A lot of the points have been raised. You know, this huge concentration of performance in a increasingly small number of names. I think I caught I would call them sort of exogenous data points that concern me. I think there's been the lowest number of insider corporate stock purchases for the past 6 years. I think that, C-suite buying less of their stock tells you all you need to know about what they're thinking on valuations. I think also another headline that kind of caught my attention is when we think back to COVID trading, the whole retail herd, through Robinhood accounts or whatever broker they use, meme stocks, were really driving some of the sentiment up. I see and read more about some of these meme stocks popping and leaving investors with really unfortunate losses. These feel to me like the last throes of a bull market, and with implied volatility where it is right now, I would consider hedging or putting some sensible hedges on into year end, just to lock in performance.
Zubin, that is a hot take, but you're not alone in that. In fact, right now, our question of the week to our audience is a very simple one. Are you comfortable buying and holding the SPX right now? And over 60%, about 61% say no. So you are not alone in that sentiment, sir. And certainly the notion that maybe now is a good time to put on a little bit of downside hedge. Certainly not alone in that sentiment either, given where we are on the vol and the skew and everything else. So interesting stuff out there. Mr. Rhoads, same question for you. Maybe not as hot take as Zubin, but if you want to do a hot take, you can. But that said, final takeaways as we look at U.S. markets and corporate structure versus our friends across the pond, sir.
Yeah, Christoph said earlier, he mentioned the U.S. consumer and the strength of the U.S. consumer, and we're getting some retail earnings this morning that are shockingly positive in the U.S. When you compare it to some of the economic numbers that we see. I I agree. And I have not been wild about U.S. stocks for some time. But I do think that maybe there's an opportunity, and again, putting on my spread trade hat, to maybe short some U.S. stocks and take a look at being long European stocks. It does feel like the risk is coming out with respect to Russia. You can sort of see it today where the spread between VSTOXX and VIX, VSTOXX is moving lower, VIX moving up a little bit, and they're both in the 15s. Typically, VSTOXX is a bit more of a premium relative to VIX. So it does feel like there's less risk stepping into Europe and maybe a bit more risk stepping into the U.S. And eventually that's going to show up in a divergence in performance.
All right, Christoph, you get the last word, at least for this segment, sir, as you like to leave our listeners with some key takeaways, some similarities or differences U.S. versus European markets and corporate structures. Have at it, sir.
Again, kind of a bit echoing what Zubin and Russell said. So there's a lot of optimism right now in the U.S. stock market, like a series of record highs, and all on the back of the trade deals and inflation not being as bad as it was. But again, I think it's still working its way through the system in terms of the impact that the tariffs will have both on inflation and also on the labor market. And we've had some pretty grim numbers, and the president firing the head of the BLS doesn't change that really, and it is incredibly important. So I think there are some risks on the horizon for the US. I think in terms of Europe, we mentioned the defense sector and its spectacular performance, and there's maybe some speculation around if Trump can pull it off and he gets Putin and Zelensky together and they end the war, and then suddenly will this all be over? But in Europe, it won't, because I think we Europeans, we've learned two things in the last couple of months. We can't really trust Vladimir Putin on ceasefires and peace negotiations, and we can no longer rely on our American friends to protect us no matter what. So the money is now committed on defense spending, on infrastructure, and this will unfold over the next decade. It's not just something that will go away just because we have some sort of peace that may or may not hold in Ukraine. So I think there's a lot speaking for Europe at the moment.
Yeah, I have a hard time, even if a ceasefire is declared right now, I have a hard time seeing Europe de-escalating anytime soon over there. So interesting stuff. Speaking of interesting stuff, you folks always have some interesting questions and insights for us. So let's get to them now as we answer the Red Phone.
What's on your mind as you're navigating the wild world of European derivatives? Let's find out as we answer the Red Phone.
All right, everybody, welcome to the Red Phone segment, our listener question segment here on the show. I love you folks. You're so patient. Send them in and wait patient. Of course, you don't have to wait if you're hanging out in our live chat listening to the show right now. I'm looking here just seeing what kind of what's resonating with our live listeners. Christoph, your comment about granolas, they do seem to be appreciating that in our live audience right now. So a little bit of fun there. A lot of them having fun also with your comments about me, Mr. Rhoads. So thank you for that. And then, of course, I'm also mentioning defense. Yeah, we got there on the defense side. And Nichols wants to know about 0 day in Europe. Well, good timing. We have another question about that. But before we get there, Mr. Rhoads, sir, this one is right up your alley. Of course, if anyone else wants to chime in, feel free. But we do call you Dr. VSTOXX for a reason. Actually, this question is addressed to you. This is from Dr. Capolio. He says, for my fellow doctor, Dr. Vix, is he noticing any interesting developments in VSTOXX regarding the recent talks about ending the war in Ukraine? So we were talking for a while, Mr. Rhoads, about the premium we're seeing between VIX and VSTOXX and how that's evolving over time. A lot of that driven by the conflict in Ukraine. Now that there is the potential, I put potential out there because obviously nothing is certain, but maybe the potential for a ceasefire. Dr. Capolio, I'm sure a lot of our listeners want to know, are you seeing any interesting developments in VSTOXX as a result?
Of course, I kind of blew it by talking about this a little bit earlier, but the spread between VIX and VSTOXX is coming down a bit. Typically, VSTOXX is at a premium. When we first had a lot of the tariff situation going on, VIX was at a premium relative to VSTOXX for an extended period of time, and that's just because there was a lot of U.S. specific risk that was associated with the tariff. They flipped back to some normalcy. We still have a pretty decent premium. August goes off the board tomorrow, and September becomes the front month. We're looking at a premium of 2.25 for September in the VSTOXX arena, and a premium of an even greater number in the U.S. arena. So another indication that VSTOXX in the VSTOXX ecosystem might be pricing in a little bit less risk over in Europe now that it appears, for better or worse, that situation may de-escalate. I'm not going to say get solved. I'm going to say de-escalate. How's that?
Well, Christoph, we were just talking about the defense sector. Obviously, a lot of that spilling over into what we're seeing on the vol surface as well. What is catching your eye out there as we're seeing potentially a ceasefire for the Ukraine conflict, sir?
Yeah, in terms of the two relative volatility measures, so what we see is that volatility in the US has been higher than in Europe, and again, I think that's down to the concentration of the market, but also what we found when we were looking at the tariffs and a trade war potentially. It always had a bigger impact on US companies because at the end of the day, the tariffs, even though Trump says we make them pay, no, it's the importers, it's the American companies, it's American consumers that pay the tariffs, right? So it has had a much bigger impact on the US market than it has had on the European market. So that certainly plays into it. And again, I would say the risk is currently higher for the US than for Europe because we're in a recovery now in Europe, and we've got these spending commitments, and so I think it's right that we have lower volatility here.
All right, we have time for one more listener question. This goes out from Elliot Andrews, and he wants to touch on what our listeners in the Pro Chat were asking, also a subject we touched on earlier in the show, which is the zero-day phenomenon. It is inescapable here in the U.S., and Elliot Andrews wants to know, has the zero DTE phenomenon spread across the pond to Europe from the U.S.? To what degree are these products even available to European traders? Well, again, we touched on this a little bit earlier in the show, so Zubin, we'll start with you, holding down the Eurex hot seat. Obviously, you can address the product side. You kind of mentioned it a little bit earlier, but let's lay it out specifically for our listeners. If they want to get in on the zero-day game in Europe, what products do they have to choose from? And then, in general, your thoughts on the degree of interest in zero-day in Europe versus here in the U.S., where it is clearly white hot.
So the good news is, yes, we have them. So we have two products. We have zero-day options on the VSTOXX 50 index and on the DAX index. So the two big European benchmarks. I would almost call them legacy products. Everyone knows those in Europe. I'm pretty comfortable your audience will be familiar with them as well. We launched them after the S&P products. I think one of the benefits or use cases we have, though, is time zone. So if you imagine we come in ahead of US central bank policy updates. We come in ahead of, we talked about it before, big earnings. We come in ahead of, Trump typing on Truth Social, so about tariffs. So the benefit of getting ahead of your day for a US customer by trading the VSTOXX 50 zero DTEs is there, right? And we see that in the volume. I think we're up to now 33,000 ADV. So it's definitely one of our more successful launches. We're pretty confident that number grows. every month. I think one thing Russell touched upon, where we still have yet to bring on, I think, a more balanced user base, is quant funds. So a lot of the quant hedge funds are still consuming our data, running back tests, training their models. And I think at some point then we get an ecosystem that feels and looks a lot like what you have in the US. Like I said, with the huge benefit that you get to trade these before your market even opens.
All right, Mr. Rhoads, you've been champing at the bit all episode long to talk zero-day. Now is the time, sir. The floor is yours. What do you have to say here for Elliot Andrews wants to know about the zero DTE phenomenon? Has it spread across the pond, sir?
It has. They're available, and I know that the EuroStoxx. The only reason I know this is because they were launched on my birthday 2 years ago. The second anniversary of the zero DTE options on EuroStoxx 50 is toward the end of this month. So we've got a couple of years of data to work with, and a variety of market environments to work with as well. And as I mentioned before, and I'm getting more and more interested in similar strategies on different markets that actually provide diversification benefits. Like I said, with EuroStoxx 50 and SPX, or actually EuroStoxx 50 and the Russell 2000 and the Nasdaq 100 have funny relationships as well that I think the quant fund should be taking a look at, because goodness knows that I am. But the lack, again, the lack of systematic sellers, and we see the systematic sellers in the U.S. in these markets every day. And I do look at the block trades in the EuroStoxx 50 and the DAX to see if there is anybody that's trying to take advantage of that type of strategy. And you just don't see the same thing in Europe as you do in the U.S., which I actually think opens up opportunities for smaller traders to take advantage of that risk premium that we expect to be able to take advantage of in option contract prices.
All right, everybody. That music means we have come to the end of another sojourn through the European markets. Hard to believe time flies when you're having fun. But before we go for this episode, let's go around the horn and check in with everyone, see what they have cooking that may interest you until our next episode of the European Market Brief. Christoph, we'll start with you. If folks are intrigued by some of the topics you've been laying down here, maybe they want to check out and learn a little bit more about SimCorp, where should they go? What should they do?
So as I mentioned, SimCorp is a fintech within Deutsche Börse Group. So we have a website, which is simcorp.com. And there you can find our research. So it's under Insights, and we have market commentary that we write every week. We have blog posts, papers on exactly the topics that we just covered. And it's all freely available. We do webinars that people can sign up to. So check it out, simcorp.com/insights, and see our research there.
There you go, simcorp.com, the place to go. And Zubin, if folks are intrigued, maybe they want to check out the sectors, or maybe they want to check out some of the zero-day products, or of course VSTOXX, where should they go to begin their journey, sir?
I'd say start on LinkedIn. I think our marketing on LinkedIn's got more active. I'm definitely posting on there. Very happy to engage with your audience. If they have any questions, they can find me on LinkedIn. Otherwise, like Christoph, we also have Eurex.com as the main, I would say, if you want to get into product specs, details, we have everything there. But I love speaking to customers. So first point of contact, they're very welcome to reach out to me via LinkedIn.
All right, and really quickly then, if you want to hit them up on LinkedIn, spell your name for the folks, sir.
Oh, wow, yeah, it's a long one. I have to apologize. So first name is Zubin, Z-U-B-I-N. Last name Ramdarshan, which is R-A-M-D-A-R-S-H-A-N.
There you go, listeners. Hit them up on LinkedIn, or of course, if you want the central repository for all the info on the products and just about everything we were talking about here on the show today, Eurex.com, EUREX.com, the place to go to kick the tires and light the fires. And last but certainly not least, Mr. Rhoads, you're always cooking up intriguing research on all things Europe versus UX, perhaps a little sprinkling of zero-day and VSTOXX in there as well. But where should folks go if they want to check all that out, sir?
Anything I do, I put out there on Twitter. So just follow me on Twitter. My full name, RussellRhoads. If you get a weatherman from Tampa, Florida, that's not me. He spells his last name a little different.
So you say, sir. But little birdie tells me you love yourself a little bit of meteorology. So I do. But that's a hobby. That's just a hobby. All right. 2 S's, 2 L's, RHOADS, all one word on your favorite social media platforms. That's going to do it for us on the European Market Brief. Not going to do it for us on the network today. We had the folks from Coinbase on the crypto show yesterday. We'll be coming back with the folks from Robinhood a little bit later today. So if you're hanging out in the Pro and you have some interesting questions for the folks over there at Robinhood, and hey, who doesn't? Start getting them in right now. We should have a fun chat coming up a little bit later today, 3 p.m. Central. Then, of course, we have our usual array of content throughout the rest of the week. Of course, Options Bootcamp, TWIFO, Vol Views, all the fun, the option block. And then we're back again, of course, for episode 9. Hard to believe, already episode 9 of the European Market Brief. We'll see you then. And, of course, stay safe out there, everybody.
The European Market Brief, brought to you by Eurex, is your trusted source for the latest insights on European trading and market trends. As the home of Euro stocks, VSTOXX, DAX, and European rates derivatives like the Bund, Bobble, and Schatz, Eurex stands as the leading European derivatives exchange. Learn more about trading Eurex futures and options at www.eurex.com.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.